Right. So JPMorgan Chase earnings just dropped, and they're looking pretty good on the surface.
Definitely.
Record net income for Q4 2024.
Okay.
We're talking like $14 billion.
Huge.
With earnings per share at $4.81.
Yep.
And for the full year, even bigger.
Right.
$58.5 billion in net income and an EPS of $19.75.
Wow.
So anyone just glancing at those numbers might think,
Right.
okay, JP Morgan's killing it.
Totally.
But as always,
We're
going deeper.
That's right.
We're going to uncover the nuances and the hidden signals behind those numbers.
Exactly. The numbers themselves are impressive for sure.
Right.
But it's the context that really matters.
Yeah, for sure.
And Jamie Dimon himself actually said it best, I think.
Okay.
He talked about the U.S. economy being resilient.
Right.
But he also pointed to two big risks.
Okay.
Inflation and geopolitical instability.
Yeah, the quote definitely jumped out at me, too.
Yeah.
It's like he's trying to walk this line between being optimistic and being cautious at the same time.
I think that's a good way to put it.
So as someone who's, really deep in the financial world, how do you interpret that statement?
Well, it's interesting because you can actually see those risks reflected in JP Morgan's own performance. Like if you look at loan growth, it's a bit of a mixed bag.
Okay.
Consumer spending is strong.
Right.
But businesses seem to be hesitant.
Interesting.
They're not taking out as many loans.
So they're kind of holding back.
Yeah, exactly. Maybe they're a little nervous.
Makes sense with all the uncertainty in the world.
Right, exactly. And here's where it gets even more interesting.
Yeah, okay.
Checking account deposits across the entire industry are way higher than they were before the pandemic.
Oh, wow.
Which suggests that consumers might be building up their cash reserves.
Like they're preparing for something.
Right. Potentially bracing for some economic headwinds.
So even though spending is strong now, those higher deposits could actually mean that people might start tightening their belts soon.
It's possible. It's like a hidden signal.
Yeah, it's kind of counterintuitive.
Right.
When everything else seems positive.
Absolutely. It's a dynamic worth watching, for sure.
Okay, so let's shift gears for a second.
Okay.
Let's talk about capital.
Oh, yeah.
JPMorgan Chase is overflowing with it.
I know, right?
They ended the quarter with $275 billion in CET1 capital.
It's incredible.
Which is just a massive amount.
It's the highest of any U.S. bank.
So they're buying back stock.
Yeah.
But with that much capital, what else could they be doing?
That's the big question everyone's asking.
Right.
Historically, JPMorgan Chase hasn't been big on special dividends.
Okay.
They see them as kind of a one-time sugar rush that doesn't really benefit shareholders in the long run.
I see.
They prefer to invest that capital in growth opportunities.
That makes sense.
Or buy back stock, which they think are more sustainable ways to increase shareholder value.
So they're kind of bucking the trend then.
Yeah, in a way.
Because a lot of companies are under pressure to offer those big payouts.
Definitely.
But some people argue that stock buybacks aren't the best use of capital either.
That's true. It's a complex debate.
Right.
Buybacks can boost earnings per share.
Yeah.
But some critics say they don't really help the broader economy.
Like investing in new businesses would.
Exactly.
Or lending to companies.
Right.
It's not as simple as JP Morgan just spending freely.
No, definitely not.
They have to think about regulatory capital requirements, too.
Oh, yeah, for sure.
Like the GSIB surcharge.
Right. That applies to big global banks like JP Morgan.
And the more capital they have, the higher that surcharge can be.
Exactly. So holding too much capital can actually become a penalty.
Okay, so that's one constraint.
Right.
What about those stress capital buffers?
Those are another key requirement.
Okay.
Banks need to hold extra capital
to
prove they can handle economic shocks. You know, like a recession or something.
Right, right.
And the Federal Reserve determines how much they need based on stress tests.
So it's a balancing act.
Yeah, for sure.
They have to keep regulators happy, but also pursue their own financial goals.
Right.
And, of course, keep their shareholders happy, too.
It's a lot to juggle.
Now, even with those record profits,
Yeah.
JPMorgan Chase admitted
Okay.
that there are some areas where they're falling short. And during the earnings call, they called these areas reds and ambers.
Reds and ambers. I like that.
Yeah, it's kitschy.
It is.
So basically it means these are the areas where they're not meeting their own internal goals.
Exactly.
Yeah.
So even though they're doing well overall,
Right.
there are some places where they're leaving money on the table.
And they were pretty transparent about it.
Yeah, I was impressed by that.
So what were some of those reds and ambers?
Well, one example they gave was wealth management for affluent clients.
Interesting.
It's a huge potential market for them.
I bet.
But it's also super competitive.
Yeah. Makes sense.
So they're basically admitting that they need to step up their game in that area.
So they see a gap between where they could be and where they actually are.
Exactly.
And this is where it gets interesting.
Okay.
Because this ties back to what Jamie Dimon said about regulation and competition. He argued that too much regulation is actually holding banks back from lending and innovating.
Yeah.
And ultimately hurting the economy.
That's a pretty bold statement.
It is.
So is he saying that JPMorgan's underperformance in some areas is because of regulations?
Right. Or there are also internal challenges that they need to fix.
That's the million-dollar question.
Right.
It's probably a combination of both.
Yeah, that makes sense.
Regulations definitely play a role. But JPMorgan also has some internal things.
Right. That they can control.
Interesting.
It just goes to show that even the most successful companies face their own unique set of challenges.
Absolutely. And that leads to a question for you.
Okay.
You know, as someone who follows this industry so closely, where else do you think JPMorgan might be missing opportunities?
That's a great question. Let me think about that for a second.
We've covered a lot already.
We have.
But I'm sure there's even more to uncover.
Yeah, I think so too.
Yeah.
Let's dive in.
Sounds good.
Okay.
Let's do it.
One area that I think is particularly interesting is their forecast for 2025.
Okay.
They're projecting a massive $94 billion in net interest income.
Yeah, that's a huge number. But
there's a catch.
There's always a catch, right? It all depends on how the market performs.
Yeah, they did say that it's very dependent on what happens in the market.
Exactly.
So essentially, they're not overly confident in their own interest rate predictions.
Yeah. I think that's a fair assessment.
I mean, their guidance is based on the current yield curve.
Right.
Which we all know
can
change like that.
In a heartbeat.
So how should we be looking at this guidance?
Well, that's the tricky part.
Yeah.
Are they just being cautious?
Okay.
You know, so they don't disappoint investors later? Or is it a sign that they're genuinely unsure about where rates are headed?
It's hard to say for sure.
It really is.
But being conservative is definitely a smart strategy.
Absolutely.
Yeah.
Especially in this market.
No one wants to make promises they can't keep.
Exactly.
But what if rates end up higher than they're currently predicting?
Then they could actually end up exceeding their guidance.
Right. It's like a double-edged sword.
It is. It's a bit of a guessing game at this point.
That's what makes earnings season so interesting, though, right?
Oh, absolutely. Trying to figure out what it all means.
Deciphering all the clues.
Exactly.
Reading between the lines.
Like a giant economic puzzle.
Speaking of puzzles.
Okay.
Let's go back to JPMorgan's balance sheet for a minute.
Their fortress balance sheet.
Right. I mean, $275 billion in CET1 capital.
It's mind-boggling.
The highest of any U.S. bank.
By far.
How did they manage to build up such a massive cushion?
Well, it's not just one thing. It's a few factors combined. Look, first, they've had consistently strong earnings for years now.
So they're making a lot of money.
Yeah.
But they're also being smart about how they manage it.
Exactly. They've retained a big chunk of those earnings. And added it to their capital base.
So they're not just spending it all.
Nope. They're building for the future.
Smart.
And they've also been careful with their share buybacks.
Okay.
They haven't gone crazy like some other banks.
Right.
They've taken a more measured approach.
Interesting.
Which has helped them build up those reserves.
The strong earnings.
Yeah.
A measured approach to buybacks.
And anything else?
Well, there were also some regulatory changes.
Oh, right.
That worked in their favor.
Like what?
Specifically, the CACL accounting standard.
Okay.
That allowed them to release some of their loan loss reserves.
Which boosted their capital even more.
Exactly.
So it's a combination of things.
Yeah.
Internal factors.
Like their earnings and capital management strategy.
And external factors.
Like those regulatory changes.
Wow.
And that strong capital position gives them a lot of flexibility and resilience.
To deal with whatever comes next.
Exactly. It's like a strategic advantage.
They can act quickly if they need to.
Yeah, whether it's acquiring a competitor.
Or weathering a storm.
Right.
I bet their investors are feeling pretty good right now.
I would imagine so. A well-capitalized bank?
Yeah.
especially in uncertain times, offers a sense of security.
It's like a safe haven.
Exactly.
Okay, so we've talked about their performance, their capital allocation, and their outlook. Right.
But there's one more thing I want to dig into.
What's that?
Their specific projections for 2025.
Oh, yeah. We touched on net interest income.
Right.
But they also gave us some insights into their expenses. Loan growth and credit quality.
All important pieces of the puzzle.
Absolutely.
So let's start with expenses.
All right.
What are they expecting?
They're projecting expenses of about $95 billion.
Okay.
Which is higher than 2024.
So expenses are going up?
Yeah, but it's mainly because they're investing in key areas.
Like what?
Technology, marketing, and expanding their workforce.
So they're basically investing in growth.
Exactly. Yeah. It's the classic spend money to make money strategy.
And are these investments aligned with their long-term goals?
Absolutely. They talked about this at their Investor Day last year.
They want to grow in wealth management, payments, and international consumer banking.
Those are the key focus areas.
Yeah, sounds ambitious.
It is. But these expense projections show that they're serious about it.
It's not just talk.
Right. They're putting their money where their mouth is.
All right. So what about loan growth?
What are they expecting there? Well, they're expecting modest loan growth overall in 2025.
Okay.
They think card and auto lending will stay strong.
So those areas are still doing well?
Yeah. But they do see some potential slowdowns.
Okay.
In things like mortgages and commercial real estate.
That makes sense.
Yeah. With interest rates being higher, it's going to affect those areas the most.
Okay. So loan growth is kind of mixed.
Yeah, a bit of a mixed bag.
Now let's talk about the big one.
Okay.
Credit quality.
The elephant in the room, right?
What are they expecting in terms of credit losses for 2025?
For their card portfolio, they're projecting a net charge-off rate around 3.6%.
Okay.
Which is pretty much what they said before.
So that tells me they're not really worried about credit quality tanking.
Even with all the talk of a potential slowdown.
Are they seeing any warning signs at all?
Not really.
Or are consumer balance sheets still looking healthy?
They still look pretty good. Unemployment is low.
So people are still working?
Yeah. But they did say that credit losses will probably go up a bit from those record lows we've seen.
Right. Things can't stay that good forever.
Exactly.
But it doesn't sound like they're expecting a huge credit crunch or anything.
Not right now.
They're definitely keeping an eye on things, though.
Oh, yeah, for sure.
And adjusting as needed.
Always got to be prepared.
Absolutely.
Yeah.
It sounds like they're being smart about managing risk.
Which is what you want to see from a bank like JPMorgan.
Exactly. That's why they're considered one of the safest and best managed banks out there.
Absolutely. They've consistently outperformed.
Right.
During tough times.
They have really good track record.
Yep.
Okay. So we've analyzed their performance, their strategy, and their outlook for the future.
We've covered a lot of ground.
We have. But I want to leave our listeners with one final thought.
Go.
JPMorgan Chase is often seen as a bellwether.
Right.
For the entire U.S. economy.
People look to them for clues.
Exactly. Because their earnings and their outlook tell us a lot about the health of the consumer.
Strength of businesses.
And the overall direction of the economy.
They're a leading indicator for sure.
So taking all of that into account, what does JPMorgan's performance in 2024 and their outlook for 2025 really tell us about the state of the U.S. economy?
Well, I think it suggests that the economy is still in decent shape.
Okay.
But there are definitely some challenges ahead.
Like inflation.
Exactly.
And those geopolitical risks.
Right. Dimon was right to point those out.
Absolutely. So I guess the key takeaway here is that we need to stay informed and be prepared for anything.
Always good advice.
And maybe even think about how these broader trends could affect our own financial decisions.
It's worth considering for sure.
Absolutely. This deep dive was just the starting point.
A jumping off point.
We've given you some key insights.
Hopefully some food for thought.
But now it's your turn.
Right.
Go explore the source material yourself.
Do your own research.
Form your own opinions.
And challenge our assumptions.
That's what makes this so interesting.
Absolutely.
There's always more to uncover.
And more to learn.
Until next time.
Keep diving deep.
That's right.